All right, so now that we've kind of ironed out the basic idea of how insurance companies operate from a financial perspective, and we've looked at their investments, their underwriting, their rate making, and all that, we kind of started from the beginning to the end. It might be good to take a step back and say, well, these are institutions, and there aren't many completely free or unregulated markets, so of course, insurance companies are probably regulated as well. So, how are insurance companies in the United States regulated? So, that's what we want to do in class today. And we can break it down into 4 or 5, a little bit more, we'll say 5 big categories here. We're going to go through each of these. Okay? So, let's start at the beginning. So, prior efforts to regulation were mostly state based. Mostly state based. We could look at the United States, maybe now, but definitely, in its beginning time, we could look at it as kind of a loose consortium of nations, nation states. And in some way, they behave separately now, too. So therefore, the discussion was, hey, we'll just let states kind of figure it out. And that worked well up until the late 1800s, when Samuel Paul, who was an insurance agent operating out of New York, wanted to sell policies to people in Virginia, people, firms, and businesses in Virginia. Okay. Virginia did not like that. They said, no, if you're going to sell in our state, you need to be licensed in our state. Paul didn't like that, makes it all the way up to a court case, and the court rules in favor of Virginia. So this kind of a little more codifies, hey, states get to decide if they don't want you selling across state lines. If they think that New York license doesn't work for Virginia, then you need to be licensed there as well. Not too dissimilar from legal license in their bar exams. Okay. Can work across some states, maybe not others. Now, so up until that point, it was kind of a loose set of guidelines. In 1944, there was another kind of kink in the chain. And really, this started about a decade before this. There are a collection of underwriters in the Southeast, Southeastern Underwriters Association. They're not very creative with names. But they're a collection of underwriters in the Southeast that were essentially colluding, setting price. So now we have this issue with this anti-competitive, again, collection or association. That issue was decided at the federal level. And that's exactly what happened. So now, the kind of basis is we regulate a little bit at the state level, but when it comes to antitrust issues, that's the federal government's job. And it's easy to see because it was difficult to see this because it was not just in one state, it was across state lines. So we go down to the south, maybe North Carolina and let's just say Alabama are not aware, they might not speak, specifically when it comes to regulating insurance. A year after that, we have the Ferguson Act, which solidified most of this state regulation with the addendum that when it comes to antitrust issues, the federal government can set it. And shortly thereafter, there was a setup of the National Association of Insurance Commissioners, the NAIC. So there's no break in communication, and we'll talk about what the NAIC does at a later time today. And then something else I do want to mention here, and I just quickly added it, and I'm not consistent with my dating here, but the FMA of 1999. All this says is that banks and insurers, S&Ls, financial firms can merge and acquire each other. Prior to this, you could only merge within industry, which doesn't really make a lot of sense if you have an M&A class or mergers and acquisition class, or you've discussed it in other classes before this. One of the big sells is that you get to diversify. But if you're an insurance company, you buy another insurance company, sure, they could write in other lines, but it's still an insurance company. Same thing with banking. The business structure is quite common. So you lose out on some of the main cells, of M&As, which is again diversification. Okay. After this, now we can merge across those kind of institutional lines within finance. All right. So how do we go about regulating insurance? Well, we can pass laws, legislation. Most current example, the Affordable Care Act. Now that's just for health insurance, but still. It's actually not just for health insurance. There are healthcare and provider changes in there too. But the health insurance industry was also affected. Probably more so. More dynamic change for the health insurance industry. Arguably. It can still go to court. So this case here was the deciding factor for the bulk of the Affordable Care Act. And what this case here ruled is that, with really just one exception, the ACA was constitutional. The one exception was Medicaid expansion. So some states opted to expand, some states opted not to expand. But most other parts were accepted. Okay. And we also have state insurance departments. Again, we have a mention here of the NAIC. And with that, we have a collection of state commissioners that come together and have pretty well set up and defined guidelines for insurers, and it's across state. So each state's commissioner. So they kind of set, again, those guidelines, best practices. They're not necessarily setting laws in a traditional sense. Now, one other big focus when it comes to regulation, and we're worrying about this market here. Not saying that we should worry, is solvency. So if a firm becomes insolvent, they're bankrupt, they can't pay their claims to anyone that they owe money to. Okay? For insurance companies, that's quite important. Right, thousands and thousands of policies. And these are to individuals that are relying on those claims payouts for very extreme losses. Their home burned down. They're without a car. They had a knee surgery that was, $60,000 or $70,000, and now their insurance company doesn't exist anymore. It's insolvent. So they're still responsible for it. Now, why does this really matter? Right? Besides the obvious, the claims aren't paid. Well, one issue is that the premiums are paid in advance. So we talked about the balancing act between earned and unearned premiums last week. We know that we can invest those premiums once we have earned them. We provided coverage protection so we can invest those. But if that did not exist, and that's a requirement, but if we did not have to disentangle earned versus unearned premiums, so if I'm an insurer and you just go ahead and pay me right now in advance for this whole next year of coverage, there's a moral hazard issue. Because we know the two ways that I, as an insurance company, want to make money. I take in your premiums, hopefully, on the underwriting side. I don't pay out as much as you paid me, hopefully. But also, I get to invest those premiums. So if there's a requirement to earning those premiums, providing you with that full year of protection, what happens is you guys pay me day one, and I invest every cent of it. And I can be as risky as I want because it's not my money. I'm only worried about bankruptcy, but I have something to gain. It's a corporation or an LLC, then it doesn't really come back on me personally either. So that premiums are paid in advance without any check or balance that we do have, but without that, there's a moral hazard issue. What I mentioned with the claims payouts, these aren't always for small claims. It could spiral for those individuals that say they have that knee surgery. Not many people sit on $60,000 or $70,000 to just pay for a knee surgery, which is about the average cost. Their health insurance company is insolvent, can't pay for it. The surgeons, doctors, nurses all provided that service. They might have to borrow money. Now they're in the hole $60,000 or $70,000, and they still pay premiums. So it's more exposure to financial insecurity as well. And then again, that also fits in with social and economic costs. Because then what if they borrow that money, they can't pay it back? That's problematic to the lender. And if the lender sees that more often than not, then they're going to have to bump their rates up, which means that when we go to borrow money, our rates might be higher too if we're part of the same market. Another issue. Insurance products are quite complicated. Yes, it's true. If we look at something like renters or homeowners or personal auto policies, they're not necessarily tailor-made. Yeah, maybe you can change the deductible, some of the liability limits here and there. But they will still be more than just one page. So within these products, there's things that the insurance company will pay and things they will not pay. There are exclusions. There are exemptions to certain exclusions. But they're complicated. And in most cases, that makes it fairly difficult to compare and contrast. Okay? Now, there are some exceptions. There are some exceptions. You know, when we look at health insurance in a couple of weeks from now, post-exam 2, when we compare individual plans on the marketplaces, it's not difficult to do. Now, some of that's the fact that you generally just have one or two plans. So it's easier. Not a lot of options on the exchanges for a couple of reasons, or a few reasons. But even if there were a large number of plans, so if we go somewhere, there are numerous counties in New York and around larger cities and in California where you will have more plans to choose from. The county here, as of last year, there were 2 plans. But you can still compare and contrast relatively easily in some markets. And again, the exchanges are actually an example of that. Nothing's perfect, but it is easy to compare and contrast individual health insurance on the exchanges. Another thing, setting these rates. So we'll bring back the kind of rate making idea. We know the actuaries set our rates, and the premium is a function of the rate also and the rate and the exposure. And it's pretty simple. We don't want to charge too much so that either we're just getting bad risk in or we're getting no risk and we're not making any money, not selling this product. But if we want to go like a market penetration strategy and charge slightly less, it could be that we're not bringing in enough to pay our claims. So that's the line to walk. Now we know that, yeah, okay, we can make a little bit back on investing. We have some room there, but that's not guaranteed. You can also lose money investing. And finally, availability. Now, your book says that it's a good idea to make insurance available to all who need it. And from a societal perspective, I don't disagree. From society, at large, I don't disagree. For a market that relies on commerce, or for an economic market, that might not be likely, might not be possible. So an ideal market, that would be true. We can adequately underwrite. Everyone has a perfect, classification of their risk. There's no adverse selection. There's no catastrophic risk. As I start rattling these things off, we start to move further and further from reality. So there are imperfections. There is asymmetric information. There are catastrophic risks. There is adverse selection. So it could be that the private institution doesn't want to, put its foot in those waters. They're a bit tumultuous. Windstorm and flood damage is a bit of an example of that. We can see catastrophic losses there. Because if your neighbor's house is damaged by wind, there's a good chance that your house is also damaged by wind. So it's catastrophic in the sense that it's highly correlated. Other examples we haven't mentioned yet, we could look at Medicaid or Medicare. So Medicaid, simplifying, it's health insurance that's for lower income individuals. Private insurer might not want to write that, or lower income individuals might not be able to afford it. So what we notice is a correlation between income and health insurance expenditures or claims. Lower income individuals, for whatever reason, tend to be less healthy. That doesn't mean it's their fault, doesn't mean there's anything wrong with that, doesn't mean that they can or cannot help it. It's just correlation. So that doesn't sound like a good market. Okay. High risk, low income doesn't sound like a good market. Again, there's nothing wrong, and it's just correlation. But if we're trying to look at it from a financial perspective, it seems problematic. Medicare, on the other hand, or on the same hand actually, we could simplify that and say, well, it's insurance, health insurance for older individuals. Okay? Health insurance for older individuals. That sounds like a terrible market too. Older individuals utilize health insurance or health care really. They utilize health care far more than younger individuals. So that sounds like a bad market too. Social Security, people don't always save for retirement. I don't want to promise to pay out. So what happens when the private sector doesn't step in is, well, maybe we need a social safety net. And we'll talk about that in later chapters. All right, so what areas do we regulate? So we've kind of covered why it's important, why we care. But what areas do we regulate? Well, from the ground up, not just any person or any collection of people can become an insurer. You have to be licensed. You have to meet certain capital or surplus requirements. So the scenario that I just pitched to you guys, if I go out and just sell a lot of, or sell you guys product, here's your policy, pay me. If I have no capital on hand, I'm not able to do that. Because what you pay me doesn't count. I didn't earn those premiums. So that doesn't count. Now, distinction between domestic, foreign, and alien insurers. If an insurance company is operating in Indiana and sells products to you, and you also live in Indiana, they're domestic. So it's within the state. So from your perspective, that's a domestic insurer. If instead you purchase a similar policy from an insurer in Ohio, let's go further away, say Florida. It's across state lines, it's foreign. If that doesn't work for you, you go north, say purchase out of Ontario. So that's alien. So it's across national lines or national borders. So within state, across state lines, and out of the U.S. That's the distinction between those three. Right. So we know solvency is important. So what are the things we look at when we're concerned with solvency? Well, the first thing is we won't always turn the regulatory microscope on every bit of an insurer's assets. We actually separate and say you have what we call admitted assets and the opposite there being non-admitted assets. Your admitted assets are things that are fairly liquid or investments. So things that could easily help you pay out your claims if you do have a clash or a catastrophic loss. Non-admitted assets would be a great example of office furniture. There is some value, but you're not going to start selling that to pay off your claims. Okay? Your surplus isn't where it needs to be. No. You have investments. You might have cash on hand. So non-admitted assets will be things, again, office furniture is a really good example. And we're not as concerned about that because it's more difficult to liquidate that. So if you get in a bind, we don't care if you have millions of dollars in office furniture. We might say that'd be a problem. Everyone has a Coco Bolo desk. Maybe they don't need that. We also keep an eye on reserves. So we know that loss reserves, especially for property and casualty insurers, that's one of their biggest liabilities. But it's an unfunded reserve account. We're just holding it as a liability. We expect to incur these losses. They've been reported, maybe they haven't. We expect to incur certain losses. If we underestimate that liability, it makes our surplus look stronger than it is, all other things constant. Because again, the surplus is just net of assets and liability. If we lower our liability by estimating or underestimating reserves, that could prove problematic. Now, as I mentioned last week, most P&C insurers tend to overestimate. And again, that moves into surplus. But something new is risk-based capital. So RBC, risk-based capital. Now, RBC, so right here. RBC is simplifying for this class, is a simple ratio of your total assets to your risky assets. Now, what factors into risk? Could be investment risk. Could be the underwriting risk of your business too. Could be operational risk. Interest rate risk. So a number of different factors. So ideally you want this ratio to be high because you have total capital and kind of what's risky. And in fact, some of the cutoff points that we'll see here, of which I only want you to be aware of two. The first one is that, okay, if that ratio is above 1.25 or 125%, that's fine. However, if you're to drop below 0.35 or 35%, you're no longer in control of your business. Regulators will seize control. Why? Because they're worried about solvency. They're worried about you paying out those claims. They're going to make sure that that doesn't happen to the best of their abilities. So, yeah, it's almost essentially look at it as a 2-to-1 ratio there. So other things in solvency regulation. So we've already discussed investments for the most part. We note that because life insurance policies are a little less volatile than property and casualty, life insurers can have longer term investments, but they're still relatively safe. Most investments tend to be bonds. They're buying bonds from other firms. It could hold some T-bills, but the payout there is pretty low. Now for dividends, we're concerned about dividends mostly due to the fact that agency conflicts could arise. So when I say dividends here, I'm not really talking about policyholder dividends. I'm talking about shareholder dividends. Let's say that we have a public insurance company. They offer stock. Just because someone buys stock from that insurance company doesn't mean they're a policyholder. So I could buy stock in your insurance company, but have nothing to do with them as a customer. So what I want is high dividends. I don't really care if they're paying out claims too much. I care if it makes them look bad, if it makes the stock price go down. But there are agency conflicts there. So the manager is conflicted on, who should they satisfy. They satisfy the policyholders so they can get you back next year, or they say, well, that's just an expense, paying out those claims. I'm a firm, I don't want to look for expenses, I want to look for revenue. And I know my shareholders will be happy, stock price will keep going up. So there could be some agency conflicts that arise. So the dividend policy is too generous, that's cash going out, assets going down. So all of things constant, surplus is going down. All right, so what happens then if an insurer becomes insolvent? If an insurer becomes solvent. So liquidate, use all that cash to pay the claims that we can, but it might not pay for all claims. So we have state guarantee funds. So state guarantee funds. And state guarantee funds pay out claims of insolvent insurers. That's what they do. Now, a couple of interesting things to note about state guarantee funds. First is that with the exception of New York, these are unfunded accounts. So they're liability accounts. Think kind of like a loss reserve account. Except now our losses are insolvencies. So that's one kind of interesting factoid. We could say that could be a shortcoming. It's never been a problem, but it could be problematic. The second issue is that these funds pay after the insolvency, and other insurers are paying. So that means if, let's say we're all operating in Indiana, we're all insurers, we're separate, we're not subsidiaries. I come into the market, my rates are too low, threatens my solvency, and my investments are bad, and I already make it a year. All right, well, I'm out of the game. Then you guys are on the hook to pay for those claims that I could not handle, or the remainder of my assets could not handle. So therein, we have another moral hazard issue, too. I'm not going to pay for it. I'm just going to go crazy with my investments and hope it works out. And how do I get more money in? I'm going to charge rates that are below what I should be charging. Maybe it works out. It's a gamble. But there's a moral hazard issue there. So that's the second problem. Another point is that the focus, and this is probably less problematic, but the focus on these guarantee funds is for individual policies. So businesses don't take precedence. Individuals do. So we'll pay out for individuals first, and then if it's like business income insurance, commercial insurance, that's very much secondary in importance. The argument there is that you're a firm, you should be able to assess the solvency or the strength of your insurer. Maybe look at their AM Best rating, an example, and you take that risk. There is a risk. So the payout doesn't really focus on commercial insurance. It's private lines first. And I think it's pretty easy to understand that and to argue that as well. Firms risk neutral, and then take care of yourselves. All right, so that's guarantee funds. All right, so they're unfunded with the exception of New York. The pay-ins kind of after the fact. So once that firm becomes insolvent, they're not the ones paying for it. Other insurers are. And then the payout focuses on private plans or individual plans. Now, with rate regulation, depending on the line or depending on the state, it could be that they set. And it could be there's a lower limit or an upper limit or both, right? Because we know there's got that sweet spot. Again, there's estimation in all this, and nothing's perfect. However, for some states and or some lines, there's no real filing required on the rates that they're set. We say the market will figure it out. If there's a problem, then if it's too high, then people won't purchase it. If it's too low, well, we're checking your RBC. We're making sure that your surplus is adequate. So it's kind of after we see a problem, rather than having to fit within these guidelines ex ante. Now, for policy forms, again, these are very complicated contracts. So each state has the authority to approve or disapprove of any contract. Now again, some of these are very consistent. So my personal auto policy, other than name and vehicle and coverage, is not going to look too dissimilar from yours, generally speaking. But states still have that authority. You need to add this, make this a bit more clear. Now, for sales practices, and then we'll touch on taxation a little bit, agents and brokers have to be licensed. So an agent is someone who works for the insurance company and sells their product. So think of a State Farm agent. They work for the insurance company and they sell those products. A broker is one who works for, let's say, a business or an individual looking for insurance products or other financial products. So what the broker will do, they'll go to numerous institutions and come back with the policies. So they, you simply think that they're representing one buyer and an agent is representing one seller. Now, of course, brokers will help multiple people or multiple businesses at the same time, but in a kind of a one period or a little selection model. That's a good way to think about it. Agent represents one company, one insured, broker, one potential insured or potential policy holder. Some of the unfair trade practices that are regulated: twisting and rebating. Twisting would be, let's say I'm an agent. I know that you're one of my policyholders. You have a pretty good policy. Let's say you could be life policy, be homeowners, but you have a pretty good policy. But then there's a new one that comes out that I get higher commissions on, but it's not really different from what you have. But I know if you buy it, I'll get paid more. I'm going to say even your premiums could be the same. But I know if you purchase this new product, which really isn't different, then I'll get a higher commission. So what I'm doing then, if I try to sell that to you, I'm trying to twist it to look like it's something that it is not. So I'm twisting that to make it look like it's something it is not. Rebating could be that same product. I know I get a higher commission, and it's so much higher that I'm willing to give you a cut of my commission. You're the policyholder. I'm willing to give you a cut of my commission. I'm going outside of my company. I'm going to cut you a check or cash under the table for my commission. I'm not taking off the product. This isn't a policyholder rebate, which that is legal. If the firm gives you a rebate, there's nothing wrong with that. But if I, as the agent, give you a rebate, or a broker, give you a piece of my commission, that's problematic too. And it could be that, again, I'm selling you a policy, I could twist and rebate at the same time. if problems like this arise or other problems with the claims process, each state has a complaint division. And most of these are fairly consumer friendly. Now, maybe that's kind of a last line of defense, but it's usually a good one. Okay, so we went over the kind of the basics here. One quick thing to mention on taxation: insurers pay all taxes that they're subject to. Whatever municipality they're in, their city they're in, they pay local taxes, so municipal taxes. They pay the state, they pay federal. They don't get around any of that. And they pay on gross premiums. Don't care about earned or unearned. Care about gross premiums. I mean, that's your revenue. That's what's coming in. Now, of course, there are expenses that that are tax deductible, but that's your primary revenue. Okay, if we recall from the very first slide, or really the second slide, we went through kind of the timeline of regulation. And we ended up saying, well, it's mostly state, with maybe the exception of, the ACA kind of went across a lot of states, but with the exception of antitrust issues. So the next question you might ask yourself, well, why is it not more regulated at the federal level? Or why is it less regulated at the federal level? Because arguments are, if we have full federal regulation, we have laws the same across all states. Some insurance is different across state lines. We tend to see states like New York and California being a little more stringent on the insurer side, where states like Georgia and Indiana are not quite as stringent. And they both have strong insurance markets. We could argue that leads to greater efficiency. We don't have to keep up with, as soon as we step across this arbitrary line, laws are different. We don't have to do that unless it's an alien insurer, we're going outside of the states. This could also lead to, your book says more competent regulators. So what's meant by that is not to say that regulators are incompetent. It just means they have more on their plate when there are 50 some odd states to worry about. And then territories too, but 50 states to worry about. It doesn't mean to imply that they're incompetent. Again, they just have a lot on their plate. So the question is, well, what are we getting out of state then? And what do we see are the shortcomings of state regulation? So what we're getting out of state regulation, so these advantages here would also be arguably disadvantages at the federal level. So the advantages of state, or again, disadvantages of federal, you could kind of say there's one and the same. So we get greater responsiveness to local needs. Windstorm and flood insurance in Florida, or in Texas. So Texas has TWIA, T-W-I-A, Texas Windstorm Insurance Association. We do have promotion of uniformity. We do. That's what the NAIC does. Now, is it the exact same thing as having a set law or rule? No. But there is promotion of some uniformity. Could lead to greater opportunity for innovation, and this goes back to the responsiveness to local needs. Now, fear of the unknown is always there, and it would probably not be an easy shift. And if it does happen, it's probably going to take some time. I might have to do it piecemeal. And another thing that, one of the arguments why we have these kind of 50 nation states is there's decentralized power. There's not one person or one close-knit group making all the decisions. So what are some of the problems that we can note? with current regulation or state regulation. There are some consumers we could argue are not as protected. It may be in those markets where there's less regulation that happens. Some states handle complaints with far more efficiency than others. Okay. With far more efficiency than others. Some states don't conduct market examinations or don't have the funds, don't have the ability to. Availability, if we look at health insurance in rural areas, and we use the exchanges as kind of a proxy for that, when you have one insurance policy to choose from, it's available, but it's hard to say that that's a competitive market. And then it could be the regulators are overly responsive, moving a little too quick, without being conservative in the traditional sense, which is to take information, look at the information, and then make the decision. So not conservative in a political sense, but more traditional way. Okay. So the last little bit here, I'm going to go through some current problems. So this is current being the last 10 to 20 years. So things that have persisted and you guys may see in the future. The first one being the 2008-9 financial crisis. There are a number of critics who said, look, credit default swaps are essentially insurance. They're not correct in saying that, but we'll let them have that. And a lot of them were sold by AIG, who also sells insurance. Never mind that they sell other products too. Therefore, the problem here was AIG credit default swaps. Not, giving, a $300,000 mortgage to a household that makes $90,000 a year and is already over-leveraged. That's not the problem. It's credit default swaps, and it's insurance. Okay, credit default swaps didn't help anything? Not at all. No. They're not really insurance, and AIG could have paid what they owed. Okay. Could have. Again, not to protect credit default swaps or AIG, by the way. Saying, if we're going to put that as the main kind of breakdown of the crisis, it's a bit difficult to do and heavy-handed to say. There's always talk of a federal charter, right? We just went through kind of the pros and cons of state versus federal. And there's always a group, not saying right or wrong at all, but always a group that thinks that we could gain more by regulating this at the federal level. I mean, banks seem to be doing okay. If we ignore that last slide talking about financial crisis. So why not regulate insurance companies at the federal level as well? There's always this kind of push. I don't see it happening in one big swoop. If it does ever happen, it's going to take some time. Okay? Again, piecemeal. Now, insolvencies are rare, but we do see them. Some of the primary reasons that we see these insolvencies, it could be the rate making and or the reserving. The rates are too low, we don't identify the risk correctly, or the exposure. The rate or the exposure is wrong, premiums aren't enough to pay for what we expect. It could be that we're under reserving. So we're underestimating our losses. Maybe we're moving too quickly. It's grow. Okay. But we don't realize every time we write a new policy, on day one that we write it, it's not helping our surplus at all. It's hurting it. It's all unearned premiums from day one. It could be that reinsurers fail to pay claims or are too slow to pay claims. Because when we talk about reinsurance, we know that the primary insurer, the ceding company, has to pay out to their policyholders. They're not just throwing those policies to someone else. They still have the policies. Their firm is named on that contract. So they still have to pay out, and then they're later reimbursed by the reinsurer. So we know that money has a time value to it. Could be poor management, fraud, and then it could just be really bad luck. Catastrophic loss. Now, we've already mentioned these. So we have RBC. We talked about IRIS a little bit last week. Financial analyst systems tracking, so FAST, that's a little new. These are just a few kind of early warning systems that we have, right? It's almost like a quick little red flag, right? Of course, RBC is kind of, we take it right here and there. We might could project in the future based on, past kind of risky, capital. But most of these are early warning kind of systems. Now, something that's a bit more recent here. Again, it's relative, last decade or so, is using credit scores as a way to kind of underwrite. So we recall that underwriting is the classification of risk. So we select the correct risk. We want to mitigate adverse selection. If you're a high risk, we want to make sure that you're paying what you should, which is higher than a low risk individual. Why? Because that creates equity across all policyholders. We don't want the low risk having to pay the high risk price. We don't want the high risk paying the low risk price or rate. The good things about this, okay? Credit scores are highly correlated really with two things here. They're highly correlated, they're positively correlated with your ability or likelihood to pay your premium. Highly correlated with your likelihood to pay your premium. Positively correlated. They're negatively correlated with your claims, your losses. So a high credit score is a really good and accurate signal of what's essentially a low risk. A low credit score would kind of be the opposite. So in this, that correlation, because that's all it is. I said nothing about causation here. Correlation does not imply causation. But that correlation with those two aspects is very, very accurate, which means it's very, very beneficial and helps with underwriting. So if you could tell me that this is 95% accurate, or 90, or even 70 or 75, I'm going to take it and run with it. So it's very useful and very accurate. Again, just correlation. Another argument, a little bit weaker, I guess, is that most consumers, in this case, most people purchasing insurance do have good credit scores. But not everybody has good credit scores. There's a distribution. So that's not as strong of an argument. So this first one here is why we kind of started using it in the first place. Now, on the other side, something that is very problematic. So we know that underwriting, we want to discriminate, but we want to discriminate based on risk. We don't want to discriminate against protected classes. Maybe certain minority groups or people of color. We don't want to discriminate from a social standpoint. Unfortunately, this high correlation, again, no causation, this high correlation, these credit scores, is also linked to other things. Okay? So there are certain groups that have lower credit scores. And it's not difficult to argue that using this would disproportionately affect those groups because their insurance premiums would be higher. So there's the issue of it being actual discrimination. Not just really cleaning out high to medium to low risk. No, actual discrimination. Now, it doesn't mean the company is trying to discriminate. It's an indirect effect, but that doesn't mean that it's okay. So that's the primary issue. It's unfortunate, it's very good. It's even more unfortunate that it's potentially discriminatory. The second 2 points here are a bit weaker. Okay. Credit reports are often wrong or contain errors. So there's no evidence to suggest that it's incorrect or it's disproportionate towards certain groups. They're incorrect, but it's just noise. So it's no more or less likely that someone not in a group that's discriminated against has an error versus someone who's in that group. So that's kind of noise. You can still say, all right, well, but it'll hurt those people, though. It would. But you'd also know if something was wrong. If you've never had a delinquency, you've always paid, mortgage, credit card, on time with a couple of exceptions, and you go in and you have a 5 in front of your credit score, and you have no large debt outstanding, then something's probably wrong. They can also be wrong in the good way. In your case, it could be higher, right? And then the other point here, again, it's not so much noise, it's just that it doesn't negatively impact any one group more than the other. So it could penalize consumers unfairly during recessions, okay, but it tends to hit all of us during a recession. Okay, so if we look at the distribution, it's not like there's a split or a truncation and some are over here and some are over there. No, it's just a shift. So the biggest reason that we want to use it is because it's very useful. It's a very useful underwriting tool. It just is. It's highly correlated with two things we really care about. Okay? It's positively correlated with your chance or probability to pay. It's negatively correlated with how expensive you are to us. That's great. It's not great in that it's not difficult to argue that it discriminates against certain groups. Okay? Not difficult to argue that at all. So that's why it's problematic. Okay? And admittedly, it's difficult to prove this, right? But it's not difficult to see or to understand. So some states disallow this. Some states are okay with credit-based insurance, of course. Okay, so that's chapter 8. Do you guys have any questions? No questions? Okay.